Bueno, buenas noches, profesor, compañeros y compañeras. Bueno, para este reto de la semana número 11, voy a leer un artículo de la Harvard Business Review a propósito de los riesgos como financieros. Bueno, entonces esto empieza así: Risk Management. Six Ways Companies Mismanage Risk, by René M. Stultz. From the magazine, March 29. As investors top up their losses from the financial crisis, many will be asking themselves, how did Wall Street mess up so badly? What went wrong with all those complicated models? Even back in November 2007, before the crisis had really hit the stock market, one commentator in the Financial Times wrote, "It is obvious there has been a massive failure of risk management across most of Wall Street." Of course, financial institutions can suffer spectacular losses even when the risk management is first-rate. They are, after all, in the business of taking risk. When risk management does fail, however, it is in one of six basic ways, nearly all of them exemplified in the current crisis. Sometimes the problem lies with the data or measures that risk managers rely on. Sometimes it relates to how they identify and communicate the risks a company is exposed to. Financial risk management is hard to get right in the best of times. In the following pages, I'll explore the six paths to failure in detail. 1. Relying on historical data. Risk management modeling usually involves extrapolating from the past to forecast the probability that a given risk will materialize. Let's assume you were a bank's risk manager in 2006, and you were worried about the chances that real estate prices will plunge over the coming year. Your bank's top executives need to know how likely such a plunge was and what losses it will cause in order to decide how much exposure the bank should have to real estate prices. You would have begun by examining the historical volatility of house prices until calculating the one-year mean price change and its standard deviation, on the assumption that they will provide a good approximation going forward. The data might have led you to conclude that house price movements are random, like the outcome of a coin toss, that increases and decreases of the same size have the same likelihood of occurring, and that small changes are much more likely than larger ones. If all this were true, then the probability distribution of how prices changes would graphically map a bell curve around the mean change. The horizontal axis of the graph will measure price changes, and the vertical axis will measure the probability that each change will occur. The shape of the bell will be determined by volatility. The greater the volatility, the flatter and wider the curve. Your modeling exercise could have gone wrong in two ways. First, if house price volatility was higher in the future than in the past, which proved to be the case, you would have substantially underestimated the probability of a plunge in prices. Your bell curves should have been flatter and wider, because the probabilities of larger price movements up or down were greater than you thought they would be. And if you had overestimated the mean change, your curve will be too far to the right, generating faulty estimates of the probabilities of all possible changes. Second, you might have wrongly assumed that the distribution of future house price changes was described by the bell curve. But if changes in price were not normally distributed, then a graph of the distribution might be skewed, just as the probability distribution of a coin's falling heads-up would be skewed if the coin were slightly bent. Both kinds of error illustrate how difficult it is to use past data to predict the future. Suppose you had looked at 13 years' worth of house price changes to estimate your mean and standard deviation. Perhaps that time frame wasn't long enough, especially if the 2 decades preceding it were more volatile. A bell curve projected from 50 years' worth of data would have been flatter than the one you plotted, or perhaps less far to the right. Or suppose a 15-year analysis showed that large changes were more likely than with the normal distribution, but a 13-year analysis did not. In that case, the 13-year analysis would understate the risk of a plunge in prices compared with the 15 years analysis, because with the latter the distribution will have fat tails relative to the normal distribution. The difficulties with historical data intensify when you start thinking about the impact of a drop in houses price of the value of assets you hold. None of the data you had would have been of much use in estimating that impact, because they didn't cover a period during which the real estate market faltered with a large number of subprime mortgages were outstanding. When many homeowners in a neighborhood have little home equity, almost always the case for subprime borrowers, and difficulty making their mortgage payments, the neighborhood enters a foreclosure spiral. Foreclosures lower prices, leading to more foreclosures because homeowners have negative equity. Your historical data could not have predicted that. For, Furthermore, if your institution had been holding complex securities that didn't exist in the period from which you drew your data, such as tranches of collateralized debt obligations backed in part by subprime mortgages, you couldn't have predicted the effect on their value of a drop in house prices. Even if you could have captured the full impact on your balance sheet of a significant downturn in real estate, you would have been vulnerable to another kind of error in estimating the indirect effects. Your bank, like another other financial institution, would have a position in many asset classes whose price changes correlate with changes in real estate. Price movements in all asset classes correlate with one another more or less, and the correlations have to be estimated correctly if you are to determine your bank's full exposure to a given risk. The higher the correlations, the riskier your total portfolio of assets, and therefore the more quality capital you will need to protect your institution against losses. Obviously, in estimating correlations from historical data, you would have been vulnerable to all the problems we have just described. To complicate matters further, correlations are not constant; in fact, they are known to increase during periods of crisis. Thus, in calculating the overall riskiness of your bank's positions, you will also have to model the probability distribution of all the correlations across your various portfolios, as well as the price distribution in each asset class, further increasing the likelihood of error. All this illustrates the inconvenient truth that rapid financial innovation over recent decades has made history an imperfect guide. 2. Focusing on narrow measures. The data used to create your models are only part of the problem. The actual measures with which you policy your risk, especially in securities trading, can also lead you to ignore risks that you should be taking into account. A daily value that risk measure is the most common way of assessing the riskiness of securities trading in financial institutions. Essentially measure the maximum amount of money you might lose at a given probability level. For instance, a bar of 100 million at the 1% level means that you have only a 1% chance of losing more than that amount over the next day. Havana sinks an upper limit to the bar it is willing to accept, say 125 million, in which case it will be comfortable with a 1% probability of losing 100 million. Large banks typically declare on a quarterly basis the number of times in the previous quarter that the P&L showed a loss higher than the daily bar. If a bank measures bar at the 1% level, it should exceed its bar roughly 1% of the time. In its annual report for 2006, the Swiss bank UBS stated that it had never had a loss that exceeded its daily bar in 2007. However, the bank exceeded its daily bar 23 times, demonstrating that risk measurement had been unable to keep up with the dramatic change in market conditions. If a bank uses bar to protect itself from losses, it may be insufficient capital to support the risk it is taking. There are several other problems with this approach. First, the simple fact that UBS experienced all those bar overruns says little about the company's actual financial health. The overruns could have been small, and a rapid increase in volatility could have created many large gains as well. Alternatively, UBS could have realized many large losses and only a few large gains. In the former case, it might it might actually be ahead at the end of the year. In the latter case, it might be in serious trouble. Second, bars do not capture catastrophic losses that have a small probability of occurring. Consider a firm with a daily bar of 100 million at the 1% probability level. If this firm exceeded its bar one on only one day out of 100 while executing thousands of trades, it will appear to have an excellent risk management record. It exceeds the bar exactly 1% of the time. This would be called comfort, however, if the amount loses above the bar, which bar is not designed to assess. Threatened the institution. Though it is hard to get data on the dollar amounts of bar overruns, the markets have been full of rumors of extremely large ones in 2008. Finally, a daily measure doesn't capture the risk of a portfolio when the firm is stuck with the portfolio for a much longer period. Daily bar measures assume that assets can be sold quickly or hedged, so a firm can limit its losses within a day. But as we have seen in 2008, and as we saw In other crises, such as the one in 1998, a dramatic withdrawal of liquidity from the markets leaves firms exposed for weeks or months on positions they cannot easily unwind. The market for many CDOs, backed in part by security subprime mortgage, essentially vanished. So banks with such CDOs on their balance sheets couldn't unload them except at fire sale prices. The risk of those CDOs during that period was unrelated to a daily bar, rather it lasted as long as the market for them was moribund, and risk increases over the time horizon for which it is computed. Overlooking no knowable risk. Bueno, voy a dejar hasta ahí porque está un poquito largo el artículo, pero ustedes lo pueden seguir leyendo. Este artículo habla de 6 formas en las que pues, las empresas gestionan mal el riesgo. Empieza a contarnos que cómo es posible que Wall Street pues, haya caído en estas crisis financieras tan complicadas. Que qué pasó pues con esos modelos para que ellos se equivocaran de tal manera, como en el año 2007 cuando llegó esa crisis de los mercados de valores. Entonces hay un fracaso masivo pues en la gestión de los riesgos, eso es lo que hablan. Entonces empieza a hablar que de eso se trata como las cuestiones financieras. Entidades como el Wall Street y como otras entidades financieras, pues de hecho cuando hacen esas transacciones monetarias asumen un riesgo. El artículo nos habla de eso, que a mayor riesgo pues se supone que mayor rentabilidad si se llegara a dar bien las cosas, pero todas las empresas que gestionan así en esos mercados bursátiles pues están inmersas en esos riesgos. Entonces nos habla, solamente alcancé como a leer dos partes del artículo. En la primera decía que hay que confiar en los datos históricos, pero que incluso eso es como que no es tan confiable, porque si uno toma, digamos, los datos históricos de 30 años, bueno, puede que con eso tenga como la información necesaria para las decisiones que toman las compañías, pero que aún así quizás sería mejor tomar 50, pero que aún esos datos históricos no le dan como la plenitud de los riesgos. O sea, que hay que mirar y medir los datos financieros del pasado y que de acuerdo a eso, pues como tomar decisiones para que a uno le vaya mejor en esos mercados bursátiles, pero que aún así sigue estando en riesgo, pero que hay que basarse pues en la historia. El segundo decía que hay que centrarse en medidas restrictivas, que resulta que los datos que utilizan pues como los datos solamente de la compañía para crear modelos pues que se pueden equivocar, que hay que tener mediciones y mirar otras entidades que han pasado por lo mismo y mirar ejemplos de otras entidades para poder medir mejor los riesgos a los que se enfrentan estas entidades. Que también este enfoque tiene problemas y que básicamente que la medición, que sería bueno poder hacer mediciones diarias para ver cómo se está calculando el riesgo y si está funcionando, si la empresa está ganando, si no, pero que ni siquiera eso da como para ver a lo largo como si se puede ganar o perder tan fácilmente. Entonces que es complicado, que el mercado de valores siempre va a representar un riesgo. Entonces alcanzamos solamente a ver eso. Ya el tercer punto decía que hay que pasar por alto los riesgos que se conocen y continuar como a nuevas experiencias, pero ya hasta ahí dejé. Muchas gracias por la atención.